I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, data on millions of Facebook users found publicly exposed on Amazon's cloud servers. We will speak with the cybersecurity firm that discovered it. Plus, as we wait for Tesla's first quarter production numbers, we take a big picture look at how the car maker can turn things up in 2019 despite the controversies and court cases with one of the biggest bulls on the street. And Twitter co-founder and CEO Jack Dorsey said new tech regulation from Europe has had a positive impact on the tech industry. He speaks to BNN Bloomberg in an exclusive interview from Toronto. We begin, though, with breaking news out of the UK, where lawmakers are now voting to block the UK from potentially crashing out of the EU without a Brexit deal, voting to block essentially a no-deal Brexit. If passed, this would be very significant. Prime Minister Theresa May would then be required to come back with a proposed extension date for lawmakers to vote on. You can see live pictures there of lawmakers voting. We're awaiting the results of that vote. I want to bring in Rosalind Matheson in London, our Bloomberg International Government Executive Editor. So, Rosalind, voting has started. What are we expecting to happen here?
Well, it's all quite messy because they're trying to rush through a bill in one day. So there are 11 amendments to get through, along with votes on each of two clauses of the bill, and then a vote on what's known as a third reading. So that's 14 votes all up. Some of them will move pretty quickly because some of them are just fixing drafting errors since the bill was written so quickly, and those votes will be uncontested. There are a couple of amendments that are important to watch, including one that stops the government seeking an extension beyond the end of June. But really, the ultimate vote is the key, and that's whether Parliament will vote to rule out a no-deal Brexit.
So how long are we expecting this latest vote to take?
It's a bit up in the air. In theory, each vote, if it happens, takes 15 minutes, but several of them, I say, will probably go through with just a nod of heads because they'll be uncontested, so we could be looking at an hour or less for that. The key question is really if that comes through, because previous votes in Parliament against a no-deal Brexit have been not binding. This is the first time that it would lock them in to that through law. The main news today, of course, though, is that Theresa May and Jeremy Corbyn are sitting down and chatting about a possible way through and a possible direction towards a softer Brexit. That's something we're watching very closely as well.
So let's walk through these two scenarios. The first is that they do vote down a no-deal Brexit. What happens then?
Well, in theory, that's a plus for Theresa May because it could force more lawmakers towards voting for her deal. Because the alternative is if they can't reach a deal, is that they'll be facing a long delay. And that could risk Brexit being called off altogether, especially if there were to be another election. So those who want Brexit may see the only solution is to vote for something, anything, even if it's not the ideal of what they truly wanted.
All right, you can see lawmakers in UK Parliament right now voting on a potential no-deal Brexit, which would prevent the UK from crashing out of the EU without a deal. As we know several times, Parliament has voted against the deals that Prime Minister Theresa May has brought forward. So, Rosalind, let's walk through the second scenario. Parliament doesn't vote down a no-deal Brexit, and that is still very much on the table. What then?
Well, it may also actually work to Theresa May's favour, oddly enough, because she can use that as leverage to bring some of the softer Brexiteers into her camp. She can say, look, the possibility of a hard exit from the EU with no rules at all about trading and regulations, what happens the day after is up in the air. That's on the table. That's still live. So you kind of need to rally behind me now and approve some sort of deal rather than facing that as a risk. So in a way, either of these outcomes could be used by her for leverage, but each outcome also comes with high risk.
All right. Well, we're going to continue to monitor what's happening in Parliament right now. Lawmakers currently voting on this potential no-deal Brexit. As Rosalind said, this would be a binding vote. We're going to wait for those votes to be counted and bring you the results as we have them. Bloomberg's Rosalind Matheson, thank you so much for joining us there from London. We'll be right back with more of Bloomberg Technology after this quick break. This is Bloomberg. Now to a Bloomberg scoop, Facebook user data is still showing up in places where it shouldn't be. Researchers at the cybersecurity firm UpGuard found troves of user information hiding in plain sight, posted publicly on Amazon's cloud computing servers. In one instance, 500 million records were openly stored on a Mexico City-based digital platform. The discovery shows that even a year after the Cambridge Analytica scandal, companies that control that information at every step still haven't done enough to seal up private data. Joining us now to discuss, our Bloomberg Tech executive editor Tom Giles, as well as Chris Vicky, director of cyber risk research for UpGuard, the firm that discovered this data out in public. So, Chris, tell us exactly what you found.
There were two finds that are reported on in this instance. The biggest one definitely was coming out of Cultura Colectiva, a Mexican media conglomerate of some sort. And it contained, as you said, over 540 million rows in this database that had records, lots and lots of fields for each one. Things like Facebook likes, Facebook reactions, Facebook friends, Facebook comments, as well as the responses to them. The same type of data that was used to create the psychographic profiles that Cambridge Analytica was in so much trouble for.
So there's a second instance you talk about, another third-party developer, 22,000 records there, so much smaller, but also these were users' passwords.
Yeah, plain text passwords, not even hashed, encrypted, encoded of any sort, just right there for anyone to see and use. And while they weren't the same thing as somebody's Facebook password, the chances of somebody reusing the same password is pretty high.
So, Tom, give us the bigger picture here. Obviously, there are multiple different parties involved. There's Facebook, there's these third parties. And let's be clear, Facebook granted access to these third parties, to this data for many, many, many years. And only after Cambridge Analytica started to do an investigation into how exactly these third parties were handling the data, then there's also Amazon.
Right.
And the third parties themselves.
Right, exactly. There's multiple parties here. We know that as Facebook has become more and more aware of the fact that this data, sort of they lost track of the data after it left their premises. They have tried to crack down, but clearly there's a lot of it out there. My question is, first of all, how much more is there? And two, what's the responsibility of the cloud services providers like Amazon Web Services in helping shore up this data and keep it from getting out into the public?
Well, to answer the first question, there's a lot more of it out there, a whole lot more of it out there. We are just scraping the surface of unsecured data out there on the cloud, available for anyone with an internet connection to connect and access, download, whatever. Where the responsibility lies is a little bit of an open question still. Companies like Amazon Web Services push a narrative of a shared responsibility model where they are responsible for the hardware, the physical security, having the security guards watch the actual servers itself. And then it's up to the other people, the ones that are paying to store the data, to correctly configure their storage instances and make sure that anybody on the internet can't access it. Now, that may change as things like GDPR, the European crackdown on privacy invasive stuff, start to go into effect. But it's still up in the air. The law isn't exactly settled in that arena.
So Facebook did give us a statement saying Facebook's policies prohibit storing Facebook information in a public database. Once alerted to the issue, we work with Amazon to take down the databases. We're committed to working with the developers on our platform to protect people's data. Now, Chris, how easy was this to find? How long did it take you to find this data?
All it took was using a keyword called data lake, because the name of the bucket was CC-data lake. So as soon as I started searching for the keyword data lake, the combination of CC comes up pretty fast. And then it said something's here. I checked it out and I was like, oh my God, there's a lot of stuff here. So it was not very difficult at all.
So really, we have no idea how many other instances there could be of this, correct?
This type of thing, this is a fairly large, on the scale of things, this was a fairly large find, but the number of fairly large finds out there could be very large itself.
I'm interested in this question of your interaction with Amazon, because you talked to them for a while, and you talked about this a little bit in your posting. You had contact with them. What was that like, and how did they respond when you told them, hey, here's what we're finding on your servers?
Well, I first notified them near the beginning of February, and they told me the bucket owner had been notified that there was an issue.
And the bucket owner here is?
Well, we still don't have absolute confirmation. We're assuming it's coming from Cultura Collectiva, that they are in control of the bucket, but they still have not issued a comment confirming that 100%. But it does stem from their systems.
So are you going to keep looking for this kind of data?
It's part of what UpGuard does, yes.
So tell us about the process. And I know you probably don't share too much about your process, but what can you tell us?
Well, yeah, it is a little bit of the secret sauce in business sense. I don't want to give away too much of our proprietary systems that we use, but it's basically the same as somebody knowing where cloud data is stored and guessing at keywords to figure out if something's there, and then checking to see if it's publicly accessible. And it's really easy to automate and do on a mass scale.
Now, there's a bigger picture issue here, which is that many companies are now storing their data on public clouds, Amazon, Google, and Microsoft, and there could be other companies that have the same problem, right?
There are, and there are going to be more big discoveries. Yes, that it is a bigger than people realize problem.
Is Facebook has said that they're going to give rewards for researchers who find certain bugs. Is that the case here? Like, are you going to get a reward from Facebook?
Well, they do offer bug bounties, but UpGuard doesn't really, it gets into a weird territory if we're hunting down this stuff and then we try to make money directly from a company that had an issue or is related to that. That's too close to a gray area. We don't accept bug bounties like that. And if we ever were offered it, we'd give it to charity. That's not something we're involved with.
My question is, what can and should Facebook do? And secondly, what's the responsibility of the Amazon Web Services out there in the world?
Facebook needs to fundamentally change their business practices. Basically, they've enabled a lot of data to get out to a lot of places and have lost control of it. There's going to be major restructuring necessary to fix it. The responsibility of something like Amazon, I would hope that when they were notified, they would have taken more steps to close it off. Like I said, we first notified them at the beginning of February, and here we are in the beginning of April, and it was just shut down this morning.
And that wasn't until we contacted Facebook and Facebook contacted them.
Exactly.
Should they have acted sooner?
In my opinion, yes, they should have. When I told them exactly what it was, they should have acted more strongly to get it shut down.
Now, is it even possible for Facebook to get control of all this data now, after the fact, after years of having this policy of giving this data away to third-party researchers, third-party developers?
No, I don't think it's possible at this point. The genie is too far out of the bottle. It's ingrained in too many other systems.
So what's next?
If you ask me, regulation with teeth is the next step, and actual enforcement.
All right, Chris Vickery, thank you so much for stopping by and sharing your discovery with us of the research firm UpGuard. We're going to wait for some more discoveries from you, as well as our very own Tom Giles. Thank you. Well, any day now, Tesla is expected to announce how many cars it built and sold for the quarter. Investors and analysts wait in suspense, considering the rocky 2018 in which production tripled while still managing to fall short of Elon Musk's dramatic targets. So what might we have in store? Joining us to discuss, we've got Bloomberg Businessweek's Max Chafkin and New Street Research's Pierre Ferragu. Pierre has a buy rating on Tesla. We still haven't got the numbers yet, Pierre, but what are you expecting?
It's very difficult to say because you have several thousand cars transiting between the Model 3 factory in Fremont and Europe and China. So that gives me a very wide range. I expect deliveries between 50,000 units, which would be very disappointing, and 65,000 units, which should be a very strong positive surprise. And that range is very similar to where consensus expectations are, with a very wide standard deviation across all my peers. So the difference between these two numbers is really how much Tesla has been able to go through the initial ramp of deliveries of cars in Europe, and to some extent in China. We know they did that extremely well over the summer in the US, but that was home. That was about taking employees to deliver cars to clients. That was epic. And they managed to deliver a very large number of cars in the very last weeks of the quarter. This time around, it's Europe. There is sea transfer involved, so it's much more uncertain.
Now, Max, this as Elon Musk himself is supposed to be in a Manhattan court on Thursday to answer to these SEC contempt charges?
Yeah, we're expecting arguments in this case over the alleged. The SEC says that Elon Musk violated the terms of his settlement, which were kind of hammered out in the wake of the famous 420 tweet, where he had tweeted that he had the funding to buy out the company at $420 a share. That turned out to be inaccurate, and we've gone down this whole road. As we talked about before, it's hard to see how this ends because, while the judge could just toss Elon Musk out of Tesla, you don't really see that as being great for investors. Most investors, I think, even bears, would agree that he's a better CEO than the next guy. So it's kind of this weird position again, though it is a source of uncertainty that's coming on top of the uncertainty of the deliveries and the production numbers.
And Pierre, you are one of the biggest bulls on the street. Does this latest kerfuffle between Musk and the SEC, I mean, it's pretty unprecedented that he's going to be appearing in court, we believe, on this very issue. Does this concern you?
Well, not that much. I think there is this aspect that the SEC might take wholeheartedly this issue, but they will remain very, very reasonable, and they're not going to hurt the company. So, it's going to be a lot of noise, it's going to be a lot of headlines, but at the end of the day, Tesla as a firm is not going to get hurt by that. The one thing that was slightly worrying me over the summer was, of course, the sanity of Elon Musk. He looked very tired, overreacting on anything, like tweeting this strange 420 tweet. I think these things are behind us. The recent times I've seen him, he looks to be in very good shape, very stable, rested. I think he turned the corner. So I am fairly reassured by that. And now the way I understand the situation is that he really accepted to settle with the SEC after the summer on advice by very close advisors and friends, but he did that against his guts. He feels the SEC is asking too much, and he feels he has a right to a fight. So that's really a personal reaction. But I don't think it's hiding like a risky personal situation that could affect the company.
All right, a distinctly positive take there, Pierre, because nobody actually knows what corner Elon Musk has turned, but I'll listen. New Street researchers Pierre Ferragu, you're going to stick with me. Max Chafkin of Bloomberg Business Week, thanks for stopping by. Coming up, Intel has a new CFO, and they poached him from one of their major rivals. What it means for the semiconductor giant, next. This is Bloomberg. Apparently for SoftBank, $100 billion isn't enough. The Japanese conglomerate is said to be in talks with investors to add as much as $15 billion more to its already massive Vision Fund. This, according to people familiar with the discussions. SoftBank plans to undergo an even more ambitious effort to assemble a second Vision Fund. Over about 2 years, the original Vision Fund has invested more than $70 billion in tech companies. Meantime, U.S. semiconductor stocks are hovering at record levels. The Philadelphia Semiconductor Index rose over 2% over the course of Wednesday's session, continuing a double-digit rise since the start of the year. Two companies in particular got a boost Wednesday. Both Intel and AMD got a buy rating from Nomura. The firm also forecasting annual sales growth for the industry as much as 9% from 2020 to 2025. To break it all down and what's happening in the chip sector, still with us, Pierre Ferragu of New Street Research, and with us in New York, Bloomberg Intelligence's senior analyst Anand Srinivasan, who covers chips and tech hardware. So, Anand, what's driving this rally?
Look, I think it's a combination of expectations and the fact that if the economy, if in fact at the margin is getting better, then semiconductors are the tip of the spear and tend to amplify those gains. Now, nobody saw this coming, both in terms of the substantial weakness that we saw in 4Q of last year and the substantial bounce back that we've seen since sort of December 25th or so back to the current levels. I think both of those were unexpected, both in terms of the ferocity, in terms of the speed, as well as in the magnitude. I think that the April quarter earnings will be a very interesting time to look back to see if those gains are indeed justified. Nobody was looking at it and say, okay, there's no weakness. There are some danger signals in certain pockets of semiconductors for 2019. But I think it's the velocity and the magnitude of the snapback that has me quite honestly concerned.
Pierre, is this a rally you expect to continue?
Well, that would be like a difficult call to make across like Q1 earnings season. Does that reflect does the rally reflect like a significant change in outlook for these players? Yes. What are the two largest drivers for the semiconductor industry today in the world? It's data centers, like the cloud players like Google and Facebook investing in their data centers, and that's smartphones. So of course, in the back end of last year, we saw like a very steep slowdown in spending by these players, and we, of course, you know what happened to Apple and how like it affected the overall smartphone markets. What we've learned across the Q4 earnings season is that yes, these players have all guided for a very low Q1, recognizing these weaknesses, but at the same time have remained relatively optimistic for their full year outlook. And then when we heard cloud players talking, they all talked up their capex. Actually, if you add up the capex of the top 7 cloud players in the world, they are expected to grow 15% this year. So it is still a growth market. And that's what the market has been progressively being recognizing over the recent weeks, which we have a very temporary slowdown in that market. And then on the smartphone front, same thing. Expectations are now more like consensual about how 2019 plays out. Investors start looking at 2020, and of course you see that the 5G is coming through, foldable phone screens are coming through, so the outlook is improving already.
All right, lots to watch as another earnings season gets underway. New Street Research's Pierre Ferragu. Always good to have you here on the show, Pierre. And Bloomberg's Anand Srinivasan. Thank you both. Coming up, Lyft losing steam after its highly anticipated IPO. What a slump means for the slew of tech companies heading to the public market next. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. It has been a tough first few days on the public market for Lyft. After much fanfare and a first-day pop in the stock, Lyft shares continues to trade below their IPO price. Now the Wall Street Journal is reporting that longtime billionaire investor Carl Icahn sold his roughly 2.7% stake in Lyft ahead of the company's market debut last week. His exact reasoning isn't known, but sources told the Journal he'd been unhappy with Lyft's plan to use super voting shares. This is investors strike a cautious tone on the stock, with the majority giving it a neutral rating. Joining us from New York to discuss, Guggenheim Securities Managing Director of Equity Research, Jake Fuller, and Bloomberg Intelligence's Mandeep Singh. So, Jake, what is your view on Lyft?
So a couple of things here. First, I'm not sure you want to read too much into the short-term trading activity. It is a high multiple story stock. You'd expect to see a little volatility around that. That being said, we did launch with a neutral rating. Bottom line for me, you have to look too far out and make some really big assumptions here around things like growth rate, margin profile, and whether or when they can get to a self-driving car future.
And look, even when I interviewed the CEO, Logan Green, he said, he couldn't give us a date when self-driving cars would be available, and yet many investors were sort of betting on them not having to pay drivers and relying on self-driving technology. Mandeep, you seem to think that the expectations for Lyft are too high, and Lyft won't be able to meet those expectations.
Yeah, so in their S1, they laid themselves out as a transportation as a service company, and a lot of people were expecting them to trade at the same multiples as software as a services companies. We don't think that's going to happen. This is still a very rudimentary market, although it's going to be very disruptive service, but no one knows the long-term profitability potential, and it just goes to show that, we're still in the early stages of this market.
Now, Jake, what do you make of Carl Icahn backing out here? I mean, the Lyft founders own 5% of shares, but have almost 50% of voting power. It is not unusual in technology. You see the same thing at Facebook, at Google. But for a company that, maybe doesn't have a lot of leverage, what do you make of a big name brand investor backing out?
Look, I'm not sure we'd make a whole lot out of it. He's been in 4 years, made a lot of money on it, not so surprising. I guess the bigger question is, what about the other large holders? You've got folks like Google, Fidelity, GM, Rakuten in there. My guess is those are more long-term holders, right? It would be scary to me if we saw one of those types leave.
Of course, Lyft investors are backing them up. I sat down with Ben Horowitz of Andreessen Horowitz on the day of the IPO. He's on the board. Of course, he's a biased narrator, but he had this to say about what Lyft has managed to pull off. Take a listen.
All these founders in Silicon Valley go, oh, nobody believed in us. When John Logan said it, they're telling the truth. Like literally, everybody had written them off. And for them to come back and go from, when I stepped onto the board, I think we're at about 16% share in the US, and we're at 39% today. So just amazing. Really, really a thrilling thing.
So Mandeep, going from 16 to 39% market share in the United States in a matter of years, do you not think that's impressive enough?
I think it's impressive, but it's built on a lot of subsidies. And like I said, this market is still rudimentary. When you look at ride hailing and the ancillary services they are offering on the bikes and scooter side, if you offer subsidies and you're burning a lot of cash, you can gain market share. But at the end of the day, you have to retain the subscribers, you have to show steady upsell, and that is much harder. So I would wait for at least a few quarters to see that steady growth in active riders and active rider pricing and stuff like that.
And look, I'd say from my vantage point that the key question here isn't what you've done, it's what you're going to do. And from the big questions around the stock, profit potential is certainly one of them that Mandeep points to. You only got 4 ways you're going to get there. You can cut driver pay, you can cut incentives that you've been running, you can bring your insurance costs down, or you can get self-driving cars. None of those things are immediately obvious.
Now, Jake, would you have the same concerns about Uber, even though it is a much bigger business?
So we don't know as much about Uber yet, right? We don't have the public filings, but it is a bit of a different animal. Number one, it's the market leader. Number two, they have a big international business. And number three, they have a large food delivery business. So a bit of a different story there.
Number three, they have a large food delivery business that they are pouring a lot of money into, and they've got other bets. Lyft sort of pitched itself as focus. Uber has, a number of different bets spread around. I mean, does that make Uber a better case, make Lyft a better case than Uber?
So I think one of the things we got to figure out here is what does the financial profile of some of those other businesses look like? We just don't have the access to the financial detail for Uber yet, so hard to say. The food delivery business in particular, though, potentially stands out, right? You do have some public companies, a company like Grubhub, where the profit margins are quite high.
Now, Mandeep, Uber we haven't seen the S1, but Uber has actually released some financial data for the last several quarters, which show that Uber's revenue much bigger than Lyft's, but also losses much bigger than Lyft. Have you done any preliminary work on how they actually compare?
Yeah, so obviously they are about 5 times bigger in revenue and booking. And, it just goes to show that they are obviously diversified, but at the end of the day, their top line is driven more by, kind of international growth as well as U.S. growth. So it's a very balanced kind of top line, whereas Lyft is more U.S. focused, and I would say Lyft has higher take rates. So one of the things we were surprised by is Lyft has take rates of about 28% now, and they have grown impressively over the last 2 years. And if I compare them to the online travel guys, Booking and Expedia, they're much better. So it's really for Lyft and Uber, the story is about containing costs now. Their take rates are very good. It's about containing costs, and I think that applies to both of them.
Right. Lyft almost solely U.S. focused, just a small business in Canada. All right. Bloomberg Intelligence's Mandeep Singh, Guggenheim Securities Managing Director of Equity Research, Jake Fuller. Thank you both.
Thank you.
Well, from its mobile payment system to a partnership with Uber, Starbucks has redefined itself as a tech player. And much of that can be attributed to CEO Kevin Johnson, who is a tech veteran himself. Before Starbucks, Johnson worked at IBM. He held several executive roles at Microsoft and Juniper, and now he's bringing that experience to one of the world's largest consumer brands. He sat down with our own David Weston to discuss.
I think of myself as a lifelong learner. And to be a lifelong learner, I've always been willing to push outside my comfort zone. And by pushing outside the comfort zone is where I learn. And I get great joy from the process of learning. And in many ways at IBM and writing software, I made the transition from being a systems engineer to sales and marketing, because I sort of loved being with people and I could leverage what I'd learned about software and what technology could do, but now I could engage with people and bring it to life for them in their businesses. And as part of that journey, I began to see the emergence of this huge new trend, the democratization of computing and the graphical user interface, and how this was no longer going to be something that is inside a data center that only large corporations have.
As you mentioned, IBM and Microsoft, there's a fair amount of creative destruction involved in those companies, including around the time you were there. What did you observe and what did you take away from those experiences?
Well, the technology industry has this unique property, and that it goes, waves of innovation hit the market, and those waves typically, the new thing disrupts the old thing, but yet it builds on top of the old thing. And it sort of reinforces the view that if you're not constantly reimagining what you're doing, consumer behavior, technology, the changes in the world, a dynamic economy, a dynamic geopolitical situation can leave you behind. But it also reinforces, in the process of reimagining the future, you have to know what grounds you to the past. Like, how do you have the wisdom to know what to honor and preserve from the past, and the courage to boldly reimagine the future? And I believe it is that balance that is the most important thing. If all you do is if all you do is hang on to the past, you will be left behind. If all you do is embrace the future and dispose of the past, you will lose your way. And so it's the balance between the two that I learned and observed throughout my entire career. And it's that balance that I'm working to apply here at Starbucks.
Weston also asked Johnson about Starbucks' evolution in the face of a mobile revolution. And Johnson talked about balancing tech with community. Take a listen.
The digital mobile revolution over the last decade has really amplified the need state of convenience. And that's true in every part of society. I mean, you can make an airline reservation, pick your seat selection, get your boarding pass, and check in on your phone, and go through TSA with your boarding pass. So this need state of convenience, you have to acknowledge, consumers are embracing it. So how do we embrace it? How do we embrace it without abandoning the need state of community, but complementing the need state of community? And that's what we have attempted to do, and I think that's what we continue to get better and better at each day. Because what I find is the same customer who at times will use the mobile app and come in and pick up their coffee is also a customer at other times. They will come in and sit down and read the paper and converse with their colleagues or their neighbors or their family members. So an individual may have both of those need states at different times of the day or different times of the week. It's our job to make sure that we can fulfill all of those in a way that I think is to the level of quality that customers expect from Starbucks.
Starbucks CEO Kevin Johnson there with Bloomberg's David Weston. You can watch that full interview on Bloomberg's Big Decisions tonight, 9:30 p.m. Eastern, 6:30 p. Pacific. Coming up, our exclusive interview with Jack Dorsey, CEO and co-founder of Twitter and Square. What he has to say about potential big tech regulation next. Blue Apron soared in trading on Wednesday after it named Etsy Chief Operating Officer Linda Findley Kozlowski as CEO. She'll replace Brad Dickerson, who the company says is resigning to pursue other opportunities. Blue Apron's co-founder and head of technology, Ilya Papas, will also step down. The meal kit delivery company also affirmed its forecast for the first quarter, including profitability on an adjusted basis. Well, Twitter co-founder Jack Dorsey is echoing Mark Zuckerberg's comments, calling for more, not less, regulation when it comes to big tech. Many social media companies have pivoted to focus on healthier conversations after criticism about fake news, hate speech, and misinformation on their platforms. In an exclusive interview with BNN Bloomberg's John Ehrlichman, Dorsey says he would welcome more regulation. Take a listen.
We've seen abuse, we've seen harassment, we've seen people leave our platform because of it, we've seen voices being silenced because of what's happening on the service, and that is number one. Like, we can't build a platform of speech, a platform of conversation, and a service that will remain relevant to people if people don't feel safe to speak up in the first place. So for all those who believe in free expression and all those who believe in free speech, it's critical that we're not utilizing technologies like Twitter to shut down voices and to silence others. And a lot of our policies and enforcement, and now more and more so technology, is aimed at addressing this problem. It's never going to be fully solved because it's one of those things where you just have to constantly iterate, and perfection is not a goal. But we need to give people much better controls over their experience, and we need to do more of the work for them. We need to take away the burden of reporting harassment or abuse. We need to utilize technology better to automatically identify where it's happening or where there's a high probability of it happening, so that people don't necessarily have to see it when they didn't ask to get into the fray as what's brought to them.
How much of it is Twitter focusing on that? How much of it is inviting more conversation from outside parties? And I ask that because for the last few days there have been a lot of headlines around Mark Zuckerberg's piece in the Washington Post about more regulation of the internet. Did you have a chance to see those comments? Would you say they align with your general views? Because you have talked about this issue before.
I think so. Generally, I think regulation is a good thing. It's a net positive, and I think our role as a company should be that of an educator, helping regulators and legislators understand what's happening with technology, the secular trends that we're seeing, that we're aware of, how our system works. And the job of a regulator is to ensure protection of the individual and a level playing field. So as long as we're working together on that, that has good outcomes. I haven't looked at all the specific feedback to Mark's post, but I generally think that there are things like GDPR that have been net positive, not just for our platform, but also for the industry in general, and specifically adds a lot more clarity around privacy. It adds a lot more clarity around how data is being used. And typically a service like ours, our terms of service are a little bit hard to read and a little bit hard to follow, and not necessarily the most customer-focused thing. So GDPR put a stake in the ground to at least bring out some elements that you had a lot more control over, and I think that's a net positive. So if there's more room for that, then yes, absolutely. But we also, there's not going to be any one party that's responsible for fixing this. I think putting too much of that weight on any one entity, whether it be a corporation, individual, a government, is just not going to work. We have to think about it a little bit differently. We have to think about it as a desire. We have a desire. Our purpose is to serve the public conversation. Our desire is to incentivize and increase healthy conversation in that. And for that, we can look much deeper. We can look at what we're incentivizing. We can look at the very foundational nature of the service and making sure that we're not incentivizing behaviors that would take away from health. And today there's areas where I think we are. So those are the questions that we're asking, and it will lead to some fundamental shifts in how the service works and how people experience it.
Here we go. Twitter CEO Jack Dorsey there with BNN Bloomberg's John Ehrlichman. For more reaction, I want to bring in Bloomberg Tech's Selena Wang, who, of course, covers Twitter. So what do you make of Dorsey's comments there, specifically about tech regulation?
Well, I think it's very far from the grand manifesto that Zuckerberg had. And when we wrote that story on Facebook calling for regulation, Twitter declined to comment. And even in this interview, you don't hear Dorsey specifically addressing all of the 4 points that Dorsey laid out. He does say, however, that regulation as a whole is a positive thing and that GDPR has been beneficial. He also admits that Twitter's terms of service is notoriously difficult to read, and that has brought some clarity around how exactly Twitter gathers data, how it's used. I think it's also worth mentioning that Twitter has less of an incentive to really play a strong role in the discourse around regulation. It's in their benefit to let Facebook set the tone, to let Facebook take the heat. And any regulation that eventually comes is going to impact a giant like Facebook and Google much more than a much smaller platform like Twitter.
I wonder if, some of these tech CEOs are simply tired of being blamed for all of these problems and would like to shift the responsibility to somebody else.
There is an interesting situation here where you have the CEOs who go out and trying to improve the public relations and the messaging around the company, but at the end of the day, we have to see the results in the company. And Jack Dorsey loves to have very idealistic visions about what the future of healthy conversation is going to be like on Twitter, but we haven't yet quite seen how that's exactly going to change in the product. Now, they have started iterating in a beta app. They're looking at ways to maybe de-emphasize the follower count, how many likes and responses people have, but to increase the encouragement of healthy conversation that's not toxic. But that's still in testing phases. It's been more than a year since he's talked about this initiative, and we still haven't seen the results.
Meantime, I want to ask you about SoftBank out there trying to raise another $15 billion for the Vision Fund. $100 billion is not enough. Talk to us about what's driving this.
$100 billion is not enough until you start looking at the pace of deal making for this company. In just about 2 years, they've invested about $70 billion into startups like Uber and WeWork and dog walking companies and cancer detection, and they don't want to slow down that pace of deal making. And if that's the case, they need to recapitalize. So we've reported that they're seeking to add another $15 billion to nearly $100 billion, and they're looking at a variety of options, including asking some of their existing backers to waive debt repayments, raising more capital. They're looking at all sorts of options. We don't know the timeline for when this may close, and it is possible that a deal could not be struck.
Where are they going to put this money?
Well, they want to continue on this grand vision of AI and the startup groups of number one. I mean, Mas has been very clear about wanting to back the leading company in every industry that is critically impacting and disrupting that sector, be that dog walking or cancer detection or ride hailing. And he said that every 2 to 3 years he wants to raise another $100 billion fund. So now we're just about getting to that point.
Now, SoftBank is interestingly a small investor in Lyft, a big investor in Uber. Do we know if they're going to make money on the Uber IPO yet? Do we expect them to?
We don't know yet. And when you talk to SoftBank, they're always talking about the long-term vision, and they're always saying that their repayments are very attractive and that the investors are interested in doubling down and recapitalizing. So there isn't a lot of transparency at this point on those numbers, but they're certainly hoping it's a positive one.
All right, Bloomberg Tech's Selena Wang, thank you very much for stopping by. Still ahead, tech companies trying to improve their diversity statistics, but are they making a difference? We're going to look at Google's latest disclosures next. This is Bloomberg. Google says its U.S. workforce has become more Asian and less white and male. The company just came out with its annual diversity report. Very small gains reported in the number of women, blacks, and Latino workers. Asian staff, however, posted the biggest increase and now make up 40% of the workforce. The bike-sharing startup Hello Bike plans to raise at least $500 million in funding as it fights for customers in China, according to people familiar with the matter. The company, backed by Ant Financial, may seek as much as $1 billion as it gauges interest from existing investors and new backers. And Netflix's pursuit of Academy Awards could become an antitrust issue. Bloomberg has learned the Department of Justice has warned the Academy of Motion Picture Arts and Sciences about potential rule changes that could hurt Netflix and other streaming platforms. And the government says that may violate laws meant to protect competition. Netflix's Roma Oscar win stirred much controversy given the film's non-traditional release in theaters before it quickly went streaming. And that does it for this edition of Bloomberg Technology. We are live streaming on Twitter. You can check us out at Technology and follow our Global Breaking News Network TikTok on Twitter. This is Bloomberg.